Gold in 2024 is the beginning of the next major leg up in precious metals. I think we'll see, above 2,072 is the actual number in US dollars for the previous high. And we'll get above that. We'll get 21, 22, 23. I think once we get into that modality, we'll see, I don't know if we'll see $3,000. I think we'll see over $30 silver next year. And once it gets above 33, there's really not much resistance. So silver could really start to spike, catch up, where we see the gold silver ratio go from like in the 80s to 70 to 60, so we might see a gold silver ratio 60 to 1 or maybe even 50 to 1 next year.
DavidMorgan of the Morgan Report foresees a significant uptrend in gold and silver in 2024. He predicts silver surpassing $30, with a notable spike after $33. Morgan suggests gold could exceed $2,072, even reaching $3,000 depending on various factors. Based on his market assessment, these are speculative analyses, not definitive forecasts. Gold and silver prices are firmer near midday Wednesday. February gold futures hit a 6-month high overnight, while March silver notched a 3-month high. Increasingly bullish near-term chart postures are boosting the two precious metals. David emphasizes the significant increase in silver demand resulting from the growing use of solar and green energy initiatives. He highlights a notable challenge within the silver market, specifically the lack of institutional investment. The industrial demand for silver in 2023 is expected to reach a new annual high. This growth is attributed to several key factors, particularly the robust expansion of the green economy, investments in photovoltaics, power grids, 5G networks, and the rising adoption of automotive electronics and related infrastructure are key drivers for this surge. The improvements in PV technology are particularly noteworthy, as the increase in cell production has outpaced silver thrifting, contributing to higher demand in the electronics and electrical sectors. David notes that economic uncertainty continues to influence the gold market, and central banks are the primary purchasers. According to the most recent data from the World Gold Council, central banks increased their gold acquisitions by 337 tons in the year's third quarter. This upswing is attributed to heightened buying from various countries, with China contributing an additional 78 tons, Poland adding 57 tons, Turkey adding 39 tons, and India adding 9 tons. Before diving into David Morgan's insightful interview, subscribe to our channel and give this video a big thumbs up.
Lastly, I'll just say I did a interview with Dr. Stephen Lieb. He's a big silver and gold bull, particularly silver, actually. He writes a newsletter like me. He's from New York. He's not on Wall Street, but close enough. Really a pretty smart guy. And he just pointed out everything that most of us silver nuts have pointed out. Current situation with solar taking so much silver, the green energy adding to the silver. And the big problem with silver, if you want to call it a problem, is there isn't any institutional investing. And normally when we get this kind of a silver market, you see some family offices, sovereign wealth funds, maybe even a country or two, money manager buy into the ETFs. And we're not seeing this time. I think that I'm almost certain that will happen. We think it will happen in 2024. So we have a strong industrial demand, and it doesn't have to be across the board. We could have a contraction in the economy, like I say, so the overall silver need industry at large, say solar, goes down. But solar's increased so much, it makes up for it. So industrial demand's higher than ever, even with all the other uses diminishing somewhat. Retail probably will come in once we get the MIMIs, because the fear of missing out will take hold of their consciousness, and then everyone sees inflation. And then lastly, you'll see the institutions will almost have to come in. It can't be the big players. Silver's such a small market, but it can be some pretty good size, sovereign wealth funds or, large trading funds or that kind of thing, which is enough to really give silver the boost it needs to start moving rapidly and sustaining. Well, the most important drivers are economic uncertainty. And the biggest buyers, of course, are the central banks. It's been that way for last year, 2022. They set a record for the last 50 years. And they're on track to be a similar amount of gold gobbling again this year. Retail's been above average, I would think. I won't know until I see the data. It's economic uncertainty, safe haven status. I'm surprised in a way, Charlotte, well beyond 2000 at this point, with all that's going on with the Ukraine war, what's going on in the Gaza Strip, Xi Jinping coming over and telling Biden what he needs to do, all the rest of it. But it is what it is. We know that the gold markets are basically derivatives markets, like all the commodities. The derivatives price are what we see. And of course, that does set the spot market. But we also know in some jurisdictions, such as the Shanghai exchange, they actually have a premium. So the market isn't all that we see. In other words, I still think gold's undervalued. It's hit it 3 times. We're up to the 4th time. Usually on the 4th try through a level, it holds it. I did an update for my subscribers because they wanted to know. It was very complimentary. One of my members said, David, I want to know if this is a breakout or a fake out. Last time when it was a fake out, you said it was. The last time when it was a breakout, you said it was. So what is it this time? And I gave them the Morgan rule. We set a line that the gold has to achieve above that price. Then it has to maintain it for 3 days in a row. And it also needs to be on above average volume. And if that occurs, then we are about 80% assured that it is a breakout. So, we'll see. I lean toward, unfortunately, I think it's going to come down again, but I could be wrong. And
David suggests that if interest rates are reduced, there could be a race to devalue the dollar, leading people to shift towards assets like gold. According to our econometric models, the long-term projection for the United States Fed funds interest rate is expected to be around 5.00% in 2024 and 4.00% in 2025. In David's view, the Federal Reserve potentially lowering interest rates is considered less favorable than maintaining higher rates. For instance, in 2020, the Fed lowered the interest rate to 0% to encourage spending and boost the economy after the pandemic-induced slowdown. However, by March 2022, as inflation approached almost 9%, the Fed began to raise interest rates to make borrowing more expensive. This move aimed to cool the economy and curb the rapid price increases seen across various goods and services. Let's get back to the interview.
a lot of my peer group have thought that we would see the Fed pause and then lower interest rates by now. They haven't. They have paused. I think that there's another raise or two, perhaps. I don't know. I know what I think all of us, and that's this. This is the thinking of the alternative media, the free market thinkers. Once the Fed pauses or lowers, that's kind of signaling to the market that we don't care about the value of the dollar. And once that happens, then it could be a race to the bottom where people just start selling dollars and buying gold as an example. That's just a real quick example, but it would be further depreciation of the dollar. We don't care. Remember when we had the zero interest rate policy? If the interest rate on something is zero, it's not worth it. But everybody, I should say, many in the financial community took great advantage of it and arbed it between different countries, borrowed dollars for zero, including the country to get. There's a lot of stuff. Plus, it can leverage. So even if you're getting 0.5%, if you leverage 10 to 1, that 0.5% goes up tenfold. So you're getting 5% back in the day when it was almost zero. Anyway, I am fearful about what happens when interest rates get lowered. I don't think it's going to help. As far as inflation, where the market starts to clear out, okay, the bonds are always going to be at least 5%. And so we've lost this much on the long end of the yield curve. And if those bonds will be worth what their par, 30 years from now, but if you need to sell them, you're going to have to sell them at a discount because that's life. I don't know if we'll get there. I do think the Fed will throw in the towel. I do think they'll start to lower. And that, I think, could be a worse scenario than having high interest rates, believe it or not. Because if we crush the economy, push hard down on the economy, and flush out all this malinvestment, take the pain, then we could come out and rebuild on a good foundation. I don't think the Fed is willing to do that. And it's hard on everybody. But if you go the other way and ease up and kiss the boo-boo and make it better, then the currency basically goes in the toilet and you can't trust it. And you have even a worse situation because that inflation psychology I just mentioned starts to catch fire and you can't stop it. Would we go into hyperinflation in the United States? No. Well, we could get to a point where it'd be close enough that we'd see real big dislocations, more than we already have.
Gold prices rallied to an all-time high on Friday after Federal Reserve Chair Jerome Powell's remarks increased traders' confidence that the U.S. central bank had completed its monetary policy tightening and could cut rates starting in March. Will the recent rally in gold prices, triggered by Federal Reserve Chair Jerome Powell's remarks and the perceived completion of monetary policy tightening, sustain momentum? Additionally, are there expectations of a rate cut starting in March? And how might this impact the trajectory of gold? Share your thoughts in the comment section. If you like the video, please subscribe to our channel. And remember to activate notifications by hitting the bell icon. Your participation means a lot to us. Thank you.